We were just talking trade with Eunice. So you figure some of it's in the market, but it would still be a big deal if it were to be resolved favorably. It's not completely reflected in the numbers. Absolutely. If you look at what the S&P has done this year, we're looking at earnings that are going to be up single digits or something like that, and yet the stocks are up 12, 13% for the S&P. And moreover, if you look at those companies that are most exposed to trade, so looking at the semiconductor companies, the semi-cap equipment companies, some of the industrials, some of the materials companies, those are up even more than the market. So I think a lot of this is already in the stocks, Joe. But of course, when you get the final news, the details will matter, and maybe that will cause them to go up a little bit more. But honestly, it may be a good idea to fade the rally if the stocks go up on a deal. So you give us specific sectors. You like consumer discretionary banks. You like the transports. Why do you like them? And you point out how on a multiple basis they're like 12 times earnings. Why are they 12 times earnings? And why do you think that it's a place to go now? So late in the cycle, transports often work. And in particular, we like the rails. And in particular, we like Union Pacific because of the change that's going on there with the new COO and with the precision scheduled railroad scheduling. They're able to really improve margins. So it's not a macro call on transports? Transports is less of a macro call. Consumer discretionary, much more of a macro call, particularly now that the Fed has paused. So consumer discretionary tends to be early, right? Doesn't do that well late. But when the Fed pauses and is no longer raising rates, and you add to that the fact that over the last decade, it's only in the last 2 or 3 years that the bottom 80% of wage earners have seen real wage growth. So that's a tailwind behind the consumer discretionary sector as well. All right, with Keon, it's always kind of episodic. I always think about the last thing you said when you were on, because you're on all the time. So it would be wrong for me to say that you're in more of a trading mode right now. In December, you figure that was a time maybe where I think you deployed some cash, but at this point you're back to where you're not overly excited about a lot of gains for the rest of the year in the averages, are you?
We have made probably more moves in the last, say, 4 months or so than we normally do.
Trading?
Yeah, trading. So we went from an underweight in early December, then back to neutral, and now slightly overweight. So we have been moving our position around a little bit more. I do think you've gotten most of what you're going to get. Now, if we do get a really breakthrough China deal, and if there's really substantive process in some of these really tough issues like technology transfer and intellectual property, then I think we could still maybe get another leg up on this in this rally. But I suspect that we've already seen most of the gains for the year. If we were able to get back to the old highs by the end of the year, I'd say that was a big win.
To the old highs.
The idea of a trade deal would fit in with this notion that this year we've seen kind of the subtraction of all fears. We worried about a too tight Fed coming into the year. Obviously worried about a U.S. kind of hard landing of some sort. If that all goes away, maybe it's an excuse for people to get more excited about the market. However, now are we just begging the Fed to cut? I mean, now we've kind of moved on.
Well, the last 6 months have been all about the Fed, right? So the move down in the fourth quarter started with Powell's comments about nowhere near neutral. The Fed did a 180 on us, and we basically have round-tripped that whole move. And we're back, more or less where we were in January of 2018, just slightly above that. So the question is, where do we break out from here? And I think it all comes down to what happens to the economy. I don't think we're going to go into recession, but if I'm wrong about that, it'll probably lead to a bear market. On the other hand, I think the more likely course is that we continue to see the economy grow at a modest pace of 2% or so. And I think the market continue to work its way higher under those circumstances. And I think also what's happening in the bond market may turn out in an odd way to be somewhat positive for stocks, in the sense that if the reason that sovereign bonds are such low yields in the U.S. and especially in Europe and in Asia, that maybe what it signals is this savings glut idea of Ben Bernanke is what's driving that move, which would help the prices of all financial assets.
Ellen, Ed says we're not going into a recession, but normally when you see the yield curve invert the way that it has, that precedes a recession by 1 to 2 years. So what do you buy going into that potential cycle? We've been upgrading quality for the last 9 months or so in our clients' portfolios, and so very slowly migrating away from the more pro-cyclical names and toward a little bit more conservative positioning, both on the equity side and on the bond side. During the periods when the yield curve is in the process of inverting, and I'm not saying that it is because we look more at the 2s 10s than at the 3-month 10, but if you look at the times when it's inverting, the S&P returns on average
9.3% annualized over those months. So as you say, it can be a year or two before we enter a recession, but those can be some of the best years for stocks.
Ed, when you look at earnings right now, so we have obviously major stories. You have Brexit, you have trade wars, you have everything there. When you look at earnings, is it unreasonable to think that's where we're getting our next directional move for the markets? Where's EPS and where's the guidance?
Well, I think we're going to have a Robert Parrish year. Robert Parrish, the great center for the Boston Celtics, his number was 0-0. So they were going to get zero earnings growth in the first quarter and roughly zero earnings growth for the year. But it probably suggests that as we get towards the second half, we'll look ahead to next year, and that will probably sit. I think most of the zero growth is largely a reaction to the tough comps from last year. So the economy is still doing okay. The weakness outside the United States is dragging down a lot of the earnings of the S&P 500 companies that get there. So even though we're at 0-0, I still think we can make a little bit of forward progress between now and the end of the year.